So we'll start very shortly. All right. So today's topic will be on the Hong Kong and China stock market market outlook itself. So without further ado, we will start the seminars soon. All right. So for this session, we have Mr. Louis Wong, Director of Phillip Securities Hong Kong, who will be covering the outlook for the China and Hong Kong stock market and his stock picks for the quarter of 4Q2024. So let us welcome Louis. Give me a moment. I think we'll be starting very shortly. Okay, so I think also there's a question on after 1 month, how much is it? You can actually see the live prices, right? So I think it's around $10+ per month after the free 1 month, but you can actually subscribe to experience it first. So I think Louis is now ready. So let's pass the time to Louis.
Hi, good afternoon, everyone. Nice to talk to you again. Hong Kong market is very, very volatile today. The Hang Seng Index at the point dropped more than 2,300 points. And is it a good opportunity to enter the Hong Kong market? I think the answer is yes. After the recent very strong rally, we see correction today, and I think the sell-off today was caused by two factors. First of all, the Asia market reopened after the National Day holiday, and the Hong Kong market failed to rise further on the strong opening of the Asia market. And secondly, the State Council Information Office held a press conference this morning at 10 a.m. If you remember, last month on the 24th of September, the China State Council Information Office also held a conference announcing the a series of policy initiatives to boost the economy, and that triggered the rally on the Asia market and the Hong Kong market. So investors have high expectation on the press conference today, but it seems to be a bit underwhelming. So investors sell on disappointment, and also some investors are taking profit on their investment, which has risen by more than some of the stocks have risen by 20, 30 or even more, 20-30% or even more in the last 2-3 weeks. So we expect this to be a correction, a technical correction after the strong rally recently, and we reckon that the fundamental for the Hong Kong stock market has improved quite substantially, and we see the uptrend will continue in the near future. Okay, let's come to our presentation today. We'll do a review on the Hong Kong stock market, the third quarter review, and then we'll analyze what are the headwinds and tailwinds the Hong Kong market, stock market is now facing, and then we'll share with you our fourth quarter outlook, our Hang Seng Index target in the fourth quarter. But I did some revision today after the sell-off this morning, and what are the sectors you are bullish about, and our stock picks. Okay. China's economy remains sluggish in the third quarter as weak domestic consumption continues to weigh on growth. Take for instance, retail price of Guizhou Moutai, which is China's premium alcohol brand, or the Agmes in China's white wine. It has fallen about 20% this year amid a pullback in spending. In the past, Guizhou Moutai was rather resilient to economic downturn. Even there was an economic downturn, Guizhou Moutai still sells so well in the past, and the retail price held up well. But this time round, even Guizhou Moutai was under pressure because of the weakening domestic consumption. Most industries within the consumer sector, from sportswear to catering and even consumer staples, saw weakening demand, and their share price performed badly this year. However, various fiscal policies have been launched after China's third plenum and political bureau meeting, such as the new guidelines to advance high-quality service consumption and allocation of 300 billion yuan in ultra-long special government bonds to boost domestic consumption in heavy machinery, electric vehicles, and home appliances. However, market responses was relatively lukewarm. That formed the background for why on the 24th of September, just now I mentioned, the State Council Information Office held a conference to release more policy initiatives, more supportive policies to boost the stock market, to support the property market, because those policies launched earlier are not received very warmly by the market. Currently, local governments are financially strapped due to debt problems. One of the pain points the Chinese government is facing is a lot of local governments are financially strapped. So, and a significant decrease in revenue from land sales. So the proportion of the central government's fiscal policies has increased to alleviate local fiscal pressures. Okay, one of the solution is to issue the so-called special long-term government bonds to provide financing to local government for spending, for public spending. The central government proposed reform. Also, the central government proposed reform of the consumption tax, which involves moving the collection stage to a later point and transitioning the consumption tax from a central tax to a shared tax. Because at the moment, all the consumption tax goes to the coffer of the central government. Going forward, the central government, Beijing, will allow provincial government to collect some portion of the consumption tax, so they can diversify their income. Okay, Hang Seng Index up to this was up to last Friday. So last Friday, the Hang Seng Index closed at 23,241, and yesterday it it was up to yesterday. Yesterday, I did this slide updated yesterday. So yesterday, the Hang Seng Index closed at 23,241, and up to last Friday, year to date, the Hang Seng Index was up 33.4%. But today, there was a huge sell-off. The index dropped to as low as 20,700, below 20,800. So it has dropped more than 2,300 points at a point today. But yet up to last Friday, Hang Seng was up 33.4% up to last Friday. And Hang Seng Tech Index was up 38.9% from the beginning of the year up to last Friday. Okay. Stock market headwinds. We are still facing a lot of geopolitical tensions, and also the uncertainty surrounding the US presidential election, who is to win the 2024 presidential election. And as for the US economy, there are still fears of hard landing, although there are also soft landing hopes. So it's a sort of tug of war between hard landing fears and soft landing hopes. And the China economy is facing deflationary risk and weakening consumer confidence. Now, I think it's very crucial whether the latest round of supportive policies or the boost to the stock market will be able to create the so-called wealth effect and enable people to spend more. So the next 1 month will be quite crucial. We'll see whether the latest policy initiatives are effective in spurring consumer spending. Okay, geopolitical tensions include cross-strait tensions between China and Taiwan, and the tensions have escalated since the election of Taiwanese leader William Lai Ching-te, granted a separatist by Beijing. And in Middle East, Gaza peace talks are still at deadlock as Israel rejects permanent truce and Iran warns Israel against full-scale attack in Lebanon. Actually, last week, Iran had fired missiles towards Israel, and Israel threatened to retaliate. Okay, so there's fear that it may a more wide-scale war may break out, and the Ukraine-Russia war now is more than 943 days. Is more than 950 days. It's day 950 something or 960. And also the territorial dispute in the South China Sea between China and its neighbors, in particular the Philippines. Okay, but stock market headwinds benefit gold. Gold prices have risen by 27.2% year to date, and we expect gold prices to be able to rise further into 2025 as US has entered a rate cut cycle, which will benefit gold further. Okay, who is to win the 2024 presidential election? Trump and Harris have clear differences on taxes, abortion, immigration, global alliances, climate change, and democracy. Trump wants the extension and expansion of his 2017 tax cuts, a massive increase in tariffs, more support for fossil fuels, and a greater concentration of government power in the White House. Whereas Harris wants middle-class tax cuts, tax hikes on wealthy and corporations, a restoration of abortion rights, and a government that aggressively addresses climate change. Okay, what's the implication to China? I think there's more worry that Trump will be re-elected because he may implement hefty tariff on China, which will hit the China exports. Okay, just now I mentioned China, the U.S. economy is still facing hard landing fears. The U.S. unemployment rate rose to 4.3% in July. It was not updated yet. In August, it has come down to 4.2%, yet still high in 12-month sense. And it has triggered in July, it's triggered the SAM rule recession indicator. The 3 months moving average of the unemployment rate more than 0.5 percentage points above the 12-month low. You can see on the chart right-hand side, in August, the SAM indicator was 0.57, which surpassed the 0.5 percentage points threshold that divide between recession and expansion, economic expansion and economic recession. In the past, the SAM rule has observed without a fail that the initial phase of a recession has started when it is triggered. So there are still some signals, some indicators indicating that hard landing or recession may still be probable. Okay. For China, the official manufacturing PMI in August was 49.1. You can see on the chart on the right hand side, on the upper chart, the official manufacturing PMI was still on a decline, which is also lower than market expectations of 49.5. In terms of enterprise size, the PMI of large enterprises, which are more resilient, was 50.4, still standing about 50 in the expansion territory. But the PMI of medium and small enterprises was 48.7 and 46.4 respectively. So the SMEs, small and medium-sized enterprises, are still in recession. The official non-manufacturing PMI in August was 50.3, higher than market expectations of 50, but still very near 50. Okay, officials said that from an industry perspective, summer consumption has played a significant role in driving business activity. Railways, air transportation, culture, sports, and entertainment industries are all in the high prosperity range, about 55. Another headwind, stock market headwind, is China slowdown in renminbi loans, loan growth. China's new renminbi loans in the first 8 months were 14.43 trillion yuan. And Reuters calculated based on data from the People's Bank of China, that new loans in August were about 900 billion yuan, lower than the expected 1.02 trillion yuan. And the total increase in aggregate financing to the real economy, 社会融资对实体经济的社会融资 in the first 8 months was 21.9 trillion yuan, a year-on-year decrease of 3.32 trillion yuan. Money supply, M0 increased by 12.2% year-on-year, but M1 decreased by 7.3% year-on-year. The decline expanded by 0.7 percentage points from last month, setting the largest decline on record. And M2 increased by 6.3% year-on-year. So this indicates that Chinese people, they do have cash, but most of them would prefer to park the cash either in government bonds or in the savings account, bank saving account, because they are quite reluctant to spend because feeling uncertain about the economic outlook. So people tend to save more rather than to spend or to invest. So it's understandable that the latest policy initiatives, the objective is to force people or to entice people to move their money out from the savings account into and invest in the stock market, and then help listing company to raise funds from the stock market, and so as to boost spending and investment. I think that's the main objective. The yield curve has shifted down recent years because just now I mentioned Chinese people, they prefer to park their cash in either government bonds or bank deposits. So this caused the yield curve to decline quite substantially, has shifted down recent years with a significant drop from 2023 to 2024 because as there is more demand for government bonds, the yield dropped as a result of the appreciation in bond prices. Okay, funds kept inflow to the long-term China government bonds, even though the yield dropped to 2.185%, which reflects people are extremely conservative in investment and spending. But lately, after the rollout of the supportive policies to boost the stock market, we read reports that a lot of new investors, freshmen, they are rushing to open securities account, especially those born after the 90s and the 2000, the younger generation. Okay. The three drivers of the economy also uh, lower than market expectation in August. Total retail sales of consumer goods in August increased by only 2.1% year-on-year, lower than market expectations of 2.5% growth. August added value of industries above designated scale increased by 4.5% year-on-year, also lower than market expectations of 4.8% growth. Fixed asset investment in the first 8 months increased by 3.4%, lower than market expectations of 3.5%, and hitting the lowest growth rate this year. Among fixed asset investment, private investment fell by 0.2%, while real estate investment fell by 10.2%. Okay, so there's the saying that the government cannot wait anymore, so they roll out last month the policies to boost the stock market as well as to lend to support the property market. You may have heard that all the first tier cities in China, including Beijing, Shanghai, Guangzhou, and Shenzhen, have all relaxed the restriction on property purchase. Okay, in the hope of revitalizing the property market. Okay, the survey urban unemployment rate in 31 major cities rose to 5.4%, a 13-month high. And various investment banks have lowered China's GDP growth forecast this year from 5% to 4.7%. Some even lowered, set the forecast at 4.6% or 4.5%. But after the latest round of policy supports, we'll wait to we'll see if investment banks will revise again their China's GDP growth forecast. This time round, they may upward revise the growth forecast slightly. Okay, economic data continues to disappoint before the latest move. Domestic demand awaiting catalyst. Now the catalyst has actually come. So in the next months, it's crucial to see whether consumer spending improve after the recent rally in the stock market. And consumer demand is weakened by debt worries and deflationary woes. Former central bank governor Yi Gang has said earlier that China should focus on ending deflation and called for proactive fiscal policies and accommodative monetary policy. Okay, now we come to the tailwinds. Start of U.S. rate cuts. U.S. economy also have soft landing hopes. China unveils most aggressive stimulus since pandemic last month. Okay, the Fed announced an interest rate cut of 0.5 percentage points, reducing the Fed funds rate to a range between 4.75% to 5%. And the following points are worth noting. The Fed estimated that U.S. GDP will grow by 2% this year, lower than the 2.1% increase expected in June. The unemployment rate at the end of this year will be 4.4%, higher than the 4% estimated in June. Core inflation was 2.6%, slower than the 2.8% forecast in June. So it's understandable that the Fed cut interest rate by 50 basis points in September. It's because the GDP growth rate they have revised downward the GDP growth rate and revised upward the unemployment rate. And core inflation was moderating, continued to moderate. Fed Chair Jay Powell said after the rate cut, the U.S. economy is in a good place, and our decision today is designed to keep it there. Okay. The rate cut, which is the Fed's first in more than 4 years, reflects its new focus on bolstering the job market, which has shown clear signs of slowing. So in the past, the Fed's main focus was to fight inflation, to contain inflation. Now, as inflation has moderated, they moved to a new focus that is to bolster, to support the job market, the labor market. The inflow of cross-border migrants is believed to be considerable, and a slowdown in hiring is driving up unemployment. The Fed's policymakers also signal that they expect to cut their key rate by an additional half point in their final 2 meetings. Another 25 basis point cut in November and another cut in December. Okay, and they envision 4 more rate cuts in 2025 and 2 in 2026. On the right hand side, you can see the dot plot, the FOMC dot plot. Okay, and after the Fed's rate cut, the Hong Kong Monetary Authority lowered its base interest rate by a half percentage points to 5.25%. And local banks in Hong Kong trimmed their prime lending rates by a quarter percentage point, first cut since 2019. With further interest rate cuts in the future, Hong Kong borrowing costs will be lower, which will stimulate personal and business borrowing activity, such as mortgage demand. As the renminbi strengthens against the US dollar, mainland tourists may increase their spending in Hong Kong because now they have a stronger purchasing power. Additionally, renminbi-denominated assets are likely to see more foreign capital inflows. With regard to the U.S. economy, there are still soft landing hopes. Among the different various economic data, most economic data in the U.S. still perform well, except the ISM manufacturing PMI and core retail sales, which are lower than expected. You can see the red color, ISM manufacturing PMI 47.2, lower than expected 47.5. Yet it improved from 46.8 the last month. And core retail sales rose 0.1%, lower than the 0.2% expected. Okay. This is most important, the latest development, and which became the catalyst for the market rally recently. China's central bank announced a suite of new heavyweight policies to boost the economy on 24th September, including cuts to the mortgage rate for existing housing and its reserve requirement ratio, RRR. While it also provided a plan to roll out new tools to support the stock market. The property support package included a 50 basis point reduction on average interest rates for existing mortgages and a cut in the minimum down payment requirement to 15% on all types of homes. In the past, they have 2 tiers. For the first home owned, the down payment requirement is 15%, but for the second home or for second homes, the down payment requirement is 25%. Now they standardized to 15%. Okay, and the reduction in the existing mortgages will help boost spending power of those who are repaying their home loans. They may save a few hundred or up to 1,000 more a month which may enable them to spend more. The reserve requirement will be cut by 50 basis points already effective, freeing up about 1 trillion yuan for new lending. Depending on the market liquidity situation later this year, the RRR may be further lowered by 0.25% to 0.5 by 0.25 to 0.5 percentage points. This is pledged by the People's Bank of China. Okay, depending on market liquidity situation, they may lower the RRR further in the future. The PBOC also introduced 2 new tools to boost the capital market. The first, a swap program sized at an initial 500 billion yuan to allow funds, insurers, and brokers easier access to funding in order to buy stocks. And the second provides up to 30 billion yuan in cheap PBOC loans, central bank loans, to commercial banks to help them fund other entities' share purchases and buybacks. So one interesting about this new tools, the swap program that aim to provide financing of 50 billion yuan to funds, insurers, and brokers, yet the only usage is for buying up stocks, for investing in the stock market. And then the 300 billion yuan cheap PBOC loans were aimed at financing shareholders, major shareholders of listed companies, and also to increase their stake in their company, and also for listed companies to do buybacks. Okay, so these 2 new tools are to boost the capital market, the stock market. Okay, Q4 outlook. Here, after the sell-off today, I did adjustment here. Near-term resistance level lower from 23,500 to 22,700. 22,700. Next resistance level, I also revised from 24,300 to 23,250. 23250. And key resistance level will also be adjusted from 25,000 to 23,500. Okay, after the sell-off this morning. And on the support side, near-term support is expected around 21,500. I make a 1,000 point adjustment. Next support level is 20,800. Also 1,000 point adjustment. And the key support level will be 20,000. 20,000. Okay. We are bullish on REITs, Hong Kong REITs and utilities. With the US kickstarting the rate cut cycle, REITs and utility stocks will remain bullish in the coming quarters. REITs and utility stocks are now still offering 5 to 8% dividend yield, very attractive, especially when US continue to cut rates, which will become more and more attractive as the US rate cycle deepens. And as the US cuts interest rate further, the Hong Kong dollar, which is pegged to the US dollar, is expected to weaken against other currencies, resulting in a decline in Hong Kongers' purchasing power when traveling abroad. So we expect Hong Kongers may travel less if the Hong Kong dollar weaken, okay, which may cause them to travel less and spend more domestically, and that will benefit the local economy. On the other hand, more tourists may visit Hong Kong and spend more here because of higher purchasing power. And short-term factors, REITs and utility stocks have risen by 20 to 30% in value since July, already pricing in the short-term interest rate cut factors. Will not be surprised to see a 5% correction in the near term. Okay, we are also bullish on Chinese SOE, the so-called China Special Valuation Stocks, 中特股. Chairman of the China Security Regulatory Commission, Yi Huimen, this is former chairman, stated in late November last year, the effort should be made to explore a valuation system with Chinese characteristics so that the market can play a bigger role in allocating resources. So to enhance the valuation of those Chinese state-owned enterprise and then lure more capital inflow into these enterprises. It aims to improve the valuation as many SOEs used to provide high dividends and stable profitability, but they have long been undervalued and overlooked by equity investors. The sectors with significant valuation gaps are mostly concentrated in banking, construction, telecommunications, petroleum, and petrochemicals, and coal industries. Key features of China's special valuation stocks, most of them pay high dividend yields, generally not less than 5%, and stable and steady growth in performance, strong resilience to risk, capable of enduring economic cycles. Stocks are still in a severely undervalued state before 24th of September, with notably low price to earnings (PE) and price to book (PBook) ratios for central SOEs. Okay. We are also bullish on industry leaders with strong domestic demand attributes. Ongoing urbanization is the main driver of China's consumption growth. As of the end of 2023, China's urban population accounted for approximately 66.2% of the total population, which is still lower than the average level of developed countries of approximately 80%. According to estimation, every 1 percentage point increase in the urbanization rate will drive an increase in consumer demand of 200 billion yuan. China has issued 300 billion yuan in treasury bonds to support government upgrade and trade-in deals for consumer goods, benefiting heavy monetary, heavy weakness, heavy industry, and home appliances and e-commerce platforms such as Alibaba and JD.com. Okay, we are upbeat on Alibaba. Alibaba has two core businesses, e-commerce and cloud computing. As part of the consumer economy in China, Alibaba has developed an ecosystem of internet platforms to tap into opportunities in local services, communications, search, and digital entertainment. With regard to e-commerce, Alibaba runs Taobao and Tmall Group, Tmall, which includes platforms for the domestic Chinese consumer and business-to-business markets, and Alibaba International Digital Commerce Group, AIDC, which includes platforms for the international consumer and business-to-business markets. Other divisions in the company provide strategic value by creating synergies. For example, the on-demand delivery business, Ele.me, this is the competitor to Meituan, provides the infrastructure for instant delivery of fresh and perishable items purchased from their e-commerce platforms. And the logistic subsidiary, Cainiao, provides the supply chain, transport, and delivery capabilities to create a great experience for the consumers to shop on the TTG and AIDC platforms. TTG stands for Taobao and Tmall Group, and AIDC stands for Alibaba International Digital Commerce Group. Okay, the other main business line, core business line under Alibaba is cloud computing. Alibaba aims to be the leading public cloud infrastructure and platform technology provider in China, supplying a broad range of capabilities to customers, including elastic computing, storage, network infrastructure, security by big data and artificial intelligence. Okay, in the second quarter this year, its revenue increased by 4% to 243.2 billion. Income from operations dropped 15% to 36 billion. Operating margin dropped 3 percentage points to 15%. Adjusted EBITDA was 51.2 billion, up 2% year-on-year. And adjusted EBITDA margin was 21%, down 2% year-on-year. The adjusted EBITDA and the adjusted EBITDA margin was down 1 percentage point year-on-year. Profit attributable to equity holders of the company was down 29% to 24.3 billion. Okay, but we do expect its financial performance to further improve in the second half of 2024 because we notice improved matching of products with user needs and conversion of user traffic to purchases through investments in technologies such as recommendation and matching algorithms, as well as increasing price competitive offerings through diversification of suppliers. In the second quarter this year, TTG Group achieved a high single-digit online GMV growth and double-digit growth, double-digit order growth year-over-year, driven by an increase in the number of purchases and purchases frequency. Okay, as for the Cloud Intelligence Group, in the second quarter this year, overall revenue excluding Alibaba consolidated subsidiaries grew by over 6% year-over-year, driven by double-digit public cloud growth and increasing adoption of AI-related products. AI-related product revenue continues to grow at triple digits year-over-year, so this will become a new growth driver for Alibaba. Alibaba Cloud has gained notable recognition as a cloud service provider of choice in China and for AI training and applications. Its AIDC Group, International Digital Commerce Group, revenue from this group grew 32% year-over-year in the second quarter this year, driven by the growth of cross-border business, in particular the choice business on AliExpress. AliExpress and Trendyol platforms step up investments in initiatives to increase mind share in select markets in Europe and the Gulf region. In the second quarter this year, revenue from Cainiao grew by 16% year-on-year, primarily driven by an increase in revenue from cross-border fulfillment solutions. In 2024 second quarter, revenue from Local Services Group grew by 12% year-over-year, driven by order growth of both Amap and Ele.me, as well as revenue growth from marketing services. Digital Media and Entertainment Group in second quarter this year, revenue from Digital Media and Entertainment Group grew by 4% year-over-year, driven by GMV and the revenue growth of its online ticketing platform for live events. Okay, I think the worst has been seen. It has been fine in 2021 for monopolistic behavior, and now it had completed a 3-year rectification, so regulatory risks appear to have diminished. The spin-off of the 6 major businesses, we think with the improvement in Hong Kong's IPO market, they may resume the spin-off plan, the listing plan of their 6 major businesses. Now, before it's still on hold, awaiting market sentiment to improve to attain a higher valuation for listing. So the timing may be right soon. As a leading e-commerce platform, Alibaba will benefit from China's 300 billion yuan allocation supporting nationwide renewal and trade-in campaign. After conversion to dual primary listing from secondary status on Hong Kong EX, Alibaba was first listed in the US and then listed on a secondary status on the Hong Kong Exchange. Now it has converted the listing to dual primary listing. So it has also joined Hong Kong EX Stock Connect, Gang Gu Tong, which will help the company tap a larger group of Chinese investors on the mainland. Estimated net inflows could be between 17 billion US dollar to 37 billion US dollar for Alibaba from mainland investors over a 12-month period. So this will lend support to its share price. Okay, today it saw a correction to around $103. So we see preliminary support around 103, between 103 and 105 Hong Kong dollars. So this is a good entry point if its share price drops to between 103 and 105 again. Okay. Tencent is a world-leading internet and technology company that develops innovative products and services. The communication and social services connect more than 1 billion people around the world. I think many of you in Singapore are also using WeChat, helping them to keep in touch with friends and family, access transportation, pay for daily necessities, and even be entertained. Tencent also publishes some of the world's most popular video games and other high-quality digital content. Tencent also offers a range of services such as cloud computing, advertising, fintech, and other enterprises services to support clients' digital transformation and business growth. Okay, this is Tencent's financial performance in the second quarter this year. Revenue was up 8% to 161.1 billion yuan. Gross profit increased 21% to 85.9 billion. Gross profit margin it was up 5.8 percentage points to 53.3%. And operation profit increased 40% to 50.7 billion yuan. Operation profit margin also improved by 7.2 percentage points to 31.5%. Profit attributable to equity holders of the company was 47.6 billion in the second quarter this year, up 82% year-on-year. Net profit margin improved to 29.6%, 12 percentage points higher than the same period in 2023. Okay. In the second quarter this year, domestic games revenue resumed growth and international games revenue accelerated growth due to increased user engagement at several of the company's evergreen titles and the successful launches of certain new games. Tencent revitalized its flagship domestic games Honor of Kings, 王者荣耀, and Peacekeeper Elite, which each resumed year-on-year growth in gross receipts in the second quarter of 2024. Naruto Mobile reached a new milestone of 10 million monthly average daily active users in May 2024. DNF Mobile, a newly released game, reactivated millions of IP fans and is retaining players well. 地下城勇士手机版, positioning it to become the next evergreen major hit. Brawl Stars achieved a historically high quarterly average DAU and ranked third internationally among all mobile games measured by DAU, benefiting from frequent content updates and social medias. The game's gross receipts grew more than tenfold year-on-year. Okay. Video accounts total user time spent substantially increased year-on-year as Tencent enhanced recommendation algorithms and provided more local content. Its mini programs, 小程序, total user time spent increased over 20% year-on-year, benefiting from its robust commerce and content ecosystem. GMV facilitated by mini programs grew at a double-digit percentage rate year-on-year. Total gross receipts of mini games increased over 30% year-on-year. And in China, approval of game licenses has been significantly accelerated. As at end of August 2024, the National Press and Publication Administration approved 925 games, including 850 domestic games and 75 imported games. 86 of approved game increases in 2023. We expect the number of both approved domestic games and imported games licenses in 2024 will be higher than in 2023, which is positive for leading game developers and issuers such as Tencent. I mentioned the game, DNF Mobile is a new superstar for Tencent. Its monthly income has remained at a top level since launch. According to Sensor Tower, a data survey agency, DNF Mobile's revenue amounted to $122 million in August, while the top-tier game, Honor of Kings, revenue amounted to $150 million US dollars in August. Although it's higher than the revenue from DNF Mobile, yet don't forget DNF Mobile is just launched lately, so it's still growing. We are positive about the growth of WeChat's video accounts, 视频号, as well as its ability of monetization through advertising and live streaming e-commerce, leveraging on the huge client base from WeChat. Okay, Tencent recently rose to about $480 yesterday. Now, today there was a correction. It went to as low as $440. So in future, we reckon that 440 Hong Kong dollars is a good entry point for Tencent, 440. Maybe between 440 and 450 lor. Okay, Meituan is China's e-commerce platform for live services. 生活服务. The company operates well-known apps such as Meituan, 电评, 大众点评, and Meituan Takeout, and its services cover catering, takeout, taxi hailing, bike sharing, in-store, hotel and travel, movies, and leisure entertainment. Its businesses cover 288 countries, districts, and cities. Financial performance did well in the second quarter. Revenue increased 21% to 82.3 billion yuan. Gross profit was up 33.4% to 33.9 billion yuan. Gross profit margin at 41.2%, 3.8 percentage points higher. Operation profit 11.3 billion yuan, up 138.8 times. 138.8%. Operation profit margin was 13.7%, significant improvement of 6.8 percentage points. Net profit increased even more by 142.1% to 11.4 billion. And the net profit margin improved 6.9 percentage points to 13.8%. Okay. The on-demand delivery business maintained steady growth in the second quarter and then further improved its operation efficiency. For food delivery, the company further focused on operational improvements in its shelf-based model and enhanced its value for money offerings, which further strengthen user stickiness, user scale, and purchase frequency. On the supply side, the company actively explored new product formats to capture different consumer demands, particularly in the low price domain. 订好饭 delivered a strong performance during the second quarter, breaking a peak daily order volume of 8 million. In-store hotel and travel business order volume grew by over 60% year-over-year in the second quarter, and annual transacting users and annual active merchants both reached new highs. In the current macro environment, demand for local services remains strong despite the changes in consumption preferences. As the company launched a new board Meituan Group by Meituan Group by 团购, it continued to leverage its self-based model to satisfy consumer demand for value for money products. It also continued to promote mega hit products by leveraging special deals and many other operational tactics. Hotel and travel experienced steady growth in both domestic home nights and GTV during the second quarter. New initiatives. Revenue from the new initiative segment increased by 28.7% year-over-year to 21.6 billion yuan, improved by 8.7 percentage points subsequently to negative 6.1%. The company improved the operational efficiency of merchants Meituan Select by enhancing product quality and strengthening supplier collaboration, which led to increases in price per item and per markup ratios and price markup ratios. We are positive about the growth of 拼好饭. 拼好饭 is a way of popular food recommendations plus group ordering plus unified delivery to mobilize users with similar work and dining rhythms and in adjacent geographical locations. So they are more centralized or concentrated in a certain geographical location. So they will mobilize users to group order takeout so that merchants can centrally prepare meals and riders can centrally deliver meals, leading to higher efficiency. Okay, 拼好饭 has become a new growth driver for many small and medium-sized merchants and helps chain restaurants improve efficiency and attract younger consumers. Other new initiatives including B2B food distribution services, RMS, bike sharing, and power banks all achieve a healthy growth and efficiency improvement. These initiatives help strengthen its entire ecosystem, increasing consumer and merchant engagement, and are expected to unlock more financial value in the future. Okay. It rose to as high as 217 Hong Kong dollars yesterday. Today, it corrected to 178, to between 178 and 180. So we reckon that if its share price corrects to between 178 to around 180 would be a good entry point. Okay, this is Meituan. The next one is Xiaomi. Remember in the last two presentations, we recommend Xiaomi, and Xiaomi did not disappoint us. Its share price went up to as high as 23.50, around 23.50 or 24, even above $24. It's an innovative technology enterprise focusing on the construction of high-end smartphones, internet TV, and smart home ecological chains. The company's main businesses include smartphones, IoT, Internet of Things, and lifestyle products, internet services, offers like smart EVs, electric vehicles. Its financial performance also impressed. In the second quarter this year, revenue was up 32% year-on-year to 88.9 billion yuan. Gross profit up 29.9% to 18.4 billion yuan. Gross profit margin, however, was slightly down 0.3 percentage points to 20.7%, but by itself 20 plus percent GP margin was still regarded as healthy. Operation profit increased by 45.7% to 5.9 billion yuan, and operating profit margin improved by 0.6 percentage points to 6.6%. Net profit increased 38.3% to 5.1 billion, and net profit margin stay at 5.7%, 0.3 percentage points higher than a year ago. Okay, according to analysts, in the second quarter of 2024, global smartphone shipments increased by 11.9% year-over-year. Xiaomi maintained its number 3 global smartphone shipment ranking with 14.6% market share. Smartphone shipments in mainland China returned to its smartphone shipments in mainland China returned to the top 5 with 14.2% market share. In addition, in Latin America, Southeast Asia, the Middle East, and Africa, its smartphone market share has increased significantly, rising to 18.6% in Latin America, 17.2% in Southeast Asia, 21.2% in the Middle East, and 11.7% in Africa. Overall, the company's global smartphone shipments were 42.2 million units, a year-on-year increase of 28.1%, which is faster than the global smartphone market shipment growth in the second quarter of 2024. Revenue for the IoT and lifestyle product segment amounted to 26.8 billion yuan, which is a record high, representing a year-on-year increase of 20.3%. And gross profit margin reached 19.7%, a year-on-year increase of 2.2 percentage points. The number of connected IoT devices, excluding smartphones, tablets, and laptops, on its AIoT platform reached 822.2 million, a year-on-year increase of 25.6%. Smart large home appliance revenue increased by 38.7% year-over-year. Shipments of various home appliances increased by more than 25% year-on-year. Tablet products continue to maintain rapid growth. According to analysts, in the second quarter this year, the company's global shipments of tablet products increased by 106% year-on-year, ranking among the top 5 in the world. It's the brand with the fastest year-on-year growth in shipments among the top 5 and ranks among the top 3 in mainland China. According to analysts, in 2024 Q2, its global shipments of wearable bands shipments ranked number 3 globally and number 2 in mainland China. Okay. Its internet services revenue reached 8.3 billion yuan in the second quarter, hitting a record high with an increase of 11% year-over-year. Gross profit margin reached, wow, very high because it's a service business, reached 78.3%, an increase of 4.2 percentage points year-over-year. Its internet user base continued to expand, and MAU stands for monthly active user globally and in mainland China, both hit record highs. In June 2024, its global MAU, monthly active users, reached 675.8 million, an increase of 11.5% year-over-year, while MAU in mainland China reached 164.4 million, up 10.1% year-over-year. In June 2024, the global monthly active user of its smart TV reached 68.8 million, an increase of 10% year-on-year. Advertising revenue reached 6 billion yuan, an increase of 16.9% year-over-year. and revenue from overseas internet services increased by 32.9% year-on-year to 2.7 billion yuan, accounting for 32.1% of total internet services revenue, up 5.3 percentage points year-over-year. Okay, smart EV and other new initiative segment recorded revenue of 6.4 billion yuan in the second quarter, which consisted of 6.2 billion yuan from smart EV and 0.2 billion yuan from other related businesses. In the second quarter this year, gross profit margin of its smart EV and other news initiative segment reached 15.4%. The company's first smart electric vehicle, the Xiaomi SU7 series, was officially released in March this year, and there are three configurations, namely Xiaomi SU7, Xiaomi SU7 Pro, and Xiaomi SU7 Max, priced at 215,900 yuan and 245,900 yuan and 299,900 yuan respectively. Okay, the company announced on Weibo that the delivery volume of Xiaomi SU7 exceeded 10,000 units in July, and the delivery volume in August will continue to exceed 10,000 units. It is expected to complete the annual delivery target of 100,000 units in November. So they achieved their annual target earlier ahead of schedule. It is expected to reach the new target of delivering 120,000 new Xiaomi SU7 series vehicles in 2024. Okay. We are optimistic about the development of Xiaomi smart electric vehicles, leveraging on the strength of its brand. It has a good brand name. Its new business is expected to constitute long-term revenue growth to the company. The smart home appliances business will benefit from China's 300 billion yuan subsidy policy, and now with the stock market rallying, people may spend more. That will also benefit the smart home appliances business. Okay, the company will also benefit from the recovery in global smartphone market sales. According to Counterpoint, in August this year, Xiaomi ranked second in global smartphone sales, surpassing Apple for the first time in 3 years and becoming the second largest smartphone brand in the world. Xiaomi will continue to integrate artificial intelligence into various businesses and combine artificial intelligence with user scenarios to empower their corporate strategy of human with car and with home. Okay, the share price, it has risen to 26.15. Sorry, I made a mistake. Yesterday it went up to 26.15, but today it corrected to close to $23. So we reckon that $23 Hong Kong dollars will be a good entry point. Okay. The last topic is 388 Hong Kong EX. I think do not need my introduction. Is one of the world's major exchanges and is a holding company listed in Hong Kong. It operates exchanges in Hong Kong and London, the LME exchange. Its members include the Stock Exchange of Hong Kong Limited, the Hong Kong Futures Exchange Limited, Hong Kong Securities Clearing Company Limited, Hong Kong Stock Exchange Options Clearing House Limited, and Hong Kong Futures Clearing Limited. The base metals market, London Metal Exchange and London Metal Exchange Clearing House are also under Hong Kong EX. Okay, in the first half this year, performance was just so-so because the market remained sluggish. The stock market remained sluggish in the first half, but we do see its financial performance brightening starting from the fourth quarter and may continue into 2025. Okay, in the first half, its revenue and other income less transaction-related expenses was around flat at 10.455 billion yuan, Hong Kong, so 10.455 billion Hong Kong dollar. EBITDA was 7.661 billion, up 2.5, down 2.5% slightly. EBITDA margin was 73.3%. Operating profit was 6.963 billion Hong Kong dollar, and operating profit margin was 66.5%. Profit attributable to shareholders of Hong Kong EX was 6.125 billion Hong Kong dollars, and net profit margin was 59.2%. Okay. Core business revenue was in line with first half 2023, as lower revenue from trading and clearing activities of the cash market. Net investment income and listing was mostly offset by higher LME trading and clearing fees driven by both volume and fee increases. So LME is helps its first half business performance. Net investment income from corporate funds was 901 million Hong Kong dollar, higher than the 870 million last year. It benefits from the high interest rate environment because he has a lot of cash. His corporate funds earns interest. The net interest income was more than 900 million Hong Kong dollars, benefiting from the high interest rate environment. Operating expenses were up 7% against first half last year, attributable to higher staff and IT costs, partly offset by the partial recovery of legal fees relating to the events in the nickel market in March 2022. Okay, business outlook. Until June 13 this year, the Hong Kong IPO market raised a total of 11.6 billion Hong Kong dollars across 27 deals, marking a decrease by 35% in funds and 15% in deal volume compared to the first 6 months last year, pushing the city down to 13th place in the global ranking of IPO markets. Hong Kong used to be among the top 3, but in the first half this year, very few IPOs. It has quieted down. So our ranking dropped to the 13th place in the first half, a letdown from its status as the world's top IPO destination in 7 of the past 15 years. But China published a set of rules in April this year that would tighten scrutiny over stock listing on the A-share market. So they discourage companies to get listed on the A-share market. In the first half this year, A-share stock exchanges collectively raised a combined 56.5 billion yuan across 52 deals, also marking a significant decrease compared to last year. In terms of funds raised, it saw a decrease of 75% in the first half this year. In terms of deal volume, it saw a decrease of 70%. Okay, the CSRC, China Securities Regulatory Committee, then introduced 5 measures on capital market cooperation with Hong Kong in April. So you remember the rally between April and May this year. It was triggered by the announcement of these 5 measures on capital market cooperation with Hong Kong from China, which includes encouraging leading enterprises from mainland China to list in Hong Kong. There are signs of Hong Kong IPO market picking up in the second half 2024, as evidenced by the surge in IPO applicants. Other measures aim to enhance the mutual accessibility between the capital markets of mainland China and Hong Kong in order to further strengthen the connectivity and competitiveness of both capital markets. Okay, the latest success, IPO success, was Media Meituan 集团. It successfully raised 31 billion yuan through its recent IPO in Hong Kong. This has not only enabled Hong Kong's IPO fundraising amount to date to exceed that of last year, but also vaulted Hong Kong into the top 5 listing. Now we rank the 4th, jumping from the 13th to now the 4th place. Bonnie Chen Eating, CEO of Hong Kong EX, noted that more than 100 new listing applications have been received this year, and there's no shortage of applicants who plan to raise $1 billion US. In addition to IPO activity, the city's secondary fundraising placement market is also on the rise, mainly through placement or sometimes rights issue, with more than $20 billion US in follow-on fundraising being completed so far this year. Okay, its share price rose to close to 400 Hong Kong dollars, and today the sell-off saw its share price dropping towards 330. So we reckon that 330 and 345 will be good entry point if for those who are upbeat about Hong Kong EX. Okay, so that ends my presentation today, and now we'll enter the Q&A and the discussion with the anchor.
Right. Thank you, Louis, for all the great sharing and the stock recommendation for Hong Kong market. So I think we do have quite a few questions on the Q&A box. So maybe let's start with the more macro question. Right. So there's a question regarding between China A shares and China H shares. Which do you think have the more upside between the next 3 to 6 months, meaning for the final quarter of this year and the first quarter of next year?
Okay, if you talk about upside, maybe Asia has more upside, but I wonder if our Singapore friends here have heard about a slang lately, very popular in the China capital market, 武则天守寡. You understand 普通话 Mandarin? 武则天 you know, is an empress in China, 武则天. 守寡 means become widow. That the implied meaning of 武则天守寡 is 失去理智, because the husband, which is the king, the Tang king, Tang emperor of 武则天, the name was Li Zi, and they pun on the word rationale, 理智. So Asian market can be rather irrational. Okay, so for irrational market, it can shoot up more. Hong Kong market is deemed to be more rational. Like today, on the reopening of the Shanghai market, the Shanghai Composite Index was at the time up 10%, and the Sunshine Index up even more than 10%. Yet the Hong Kong market, we saw profit taking. So investors are more rational here. Okay, so to answer your question, I think Asia may have more upside on the assumption that investors on the mainland are more irrational. Okay, but for I mean, it will also mean it's more risky and more volatile. Okay, so buyers beware.
Understand. Right. So another question is regarding this. We see that China government have done quite a fair bit of new measures this year to boost the China economy. So in your view, do you think it is enough in the sense of what they have done right now, or do you think more is needed to be done, and whether the government will do the more actions required?
Okay. It's hard to say now, because it's clear in the past that now Europe had decided on levying tariffs on China's EV. Okay, and US, if Trump is being re-elected, he has threatened to levy 60% tariff on China. That is more because of the the tension between China and other Western countries in the last few years. Okay, but there may be some tweaks going forward. Some political observers observed that in the National Day ceremony lately, you know who sat beside Chairman Xi Jinping? Is Wen Jiabao, Premier Wen Jiabao, the former premier. Okay, he was sitting on his left. Okay, on his right side was another senior official that had actually retired, but now came back again. There was Li Huihuan, 90 years old. Okay, so the interpretation was now they are trying to get the support or get these old retirees to come back to help. I mean, reform the economy to come up with more effective policies to support the economy. And there's also conjecture that they may see some rebuilding the relation between China and the West. If Wen Jiabao, because in the past they are more friendly to Western countries. So if there's a twist and turn in the political stance in China, then Western countries may be less hostile in future, and we may expect less stringent tariffs or less stringent trade policies on less harsh trade policies on China that will benefit China. But this remains to be seen. It's just some political observation lately. Whether the observation is accurate remains to be seen. No, but the other what's the other part of the sentence? Oh, long term. Whether I think the rally was mainly by short term investors. But China has after the State Council Information Office press conference on the 24th of September. If you recall, on the 26th of September, the 中央政治局, the China Politburo, they call a meeting. And then one of the initiatives they proposed was to encourage long-term capital, such as insurers and insurance companies to invest more in the stock market. So they want to have more long-term capital to invest in the stock market instead of just short speculators, punters playing the stock market. And so it remains to also, it takes time to see if more long-term capital will come back, will return to the China market. For the time being, as far as international fund flow is concerned, for the time being, we notice there are more fund flows from hedge funds. They are more sensitive to this change in market sentiment. But if China's economy proves to see some pickup, the momentum, the growth rate accelerate, then we are also confident that long-term international fund, some long-term international funds will return to China and Hong Kong.
Right, that's great to hear. So another set of questions, I think there are some questions all related to the SOE, which you mentioned as one of the bullish sectors that you think will do well upcoming in the current outlook. So he's asking what are some of the examples or names of SOEs do you think that will do well? as well as what are some of the ETF that they can actually consider to get the exposure into the utility and the SOEs that are in China?
Okay. Among the SOEs, now we prefer the telcos, such as China Mobile, China Telecom, China Mobile, and Unicom, because they are more resilient to the economy, and their dividend yield are still quite attractive, paying around 7 to 8% dividend yield, and single-digit PE. And the other sector we favor are insurance companies such as China Life, Ping An, compared to the banks, because China is going to lower interest rate as well. So banks may be under pressure. The net interest margin may be under pressure. But for insurance company, their investment income, the investment return will be enhanced if we see better performance in equities market and also bond markets. Okay, so China telcos and China insurers are the two types of SOEs we prefer. Okay, as that's another one is oil and gas company, but very dependent on oil prices. And for oil prices, personally, I view that they are both headwinds and tailwinds. They are both favorable and unfavorable factors. Favorable factors are now on the demand side. After these policy support, China's economic growth may pick up, and U.S. if is heading for a soft landing, so we expect better demand from the two largest consumer countries of oil, U.S. and China. As for negative factors, now it's more on the supply side because OPEC Plus will be increasing their output starting from December this year. So this will mitigate one another. But if another wild card will be the geopolitical tensions in the Middle East. If war, we accelerated in the conflicts, military conflicts accelerated in the Middle East, it may push up oil prices and will benefit the 三桶油, the three barrels of oil, namely CNOOC, PetroChina, and Sinopec. So these three groups of SOE. There is one SOE ETF, but I need to check the ticker. Let me check first. Yeah, it's managed by Bosera, Bosera. It focuses on central bank state-owned enterprises. The ETF, it's ETF for SOE. The stock code, let me see the stock code, whether there's a stock code here. It was launched in December last year. Let me see. It includes nearly 50 industry-leading central SOEs in sectors like energy, communication services, industrials, utilities, and healthcare. Let me see the ticker. If I Can't find the ticker here. Maybe let me see. You can search by the name. The name is Bosera. The fund house is Bosera, and it's known as SOE, China SOE ETF.
Yeah,
I'm
I think
trying to
I
see.
saw, is it the Bosera China Reform Hong Kong Central SOE?
Yeah.
Okay, that's the 3437.
Okay.
3437.
3437.
Yeah.
And just now I mentioned the IPO market, which has brightened up, and we do expect more listing of mega companies from China. So another ETF I would like to mention to you is the Hong Kong newly listed equities ETF. Phillip Hong Kong newly listed ETF equities ETF managed by PhillipCapital Management Hong Kong. The stock code is 2835. So it comprised from 35 to 50 constituent stocks, companies that are listed within the last 3 years. Okay, now it comprises companies like the three EV makers, Li Auto, Xiaomi, and NIO, and also Bilibili, Baidu, Trip, TRIP. So the lot size is 100 shares, now trading at around $10 something, $10 plus. So with 1,000 Hong Kong dollars, you can own a group of newly listed companies, which may have the potential to grow into much bigger companies. Okay.
Right. I think that's a great idea for investors want to try into the new IPOs but not into individual counters. Right. So next, I think there's some question. I think you mentioned about the China bank, but this question is specifically into the Hong Kong banks itself. Any particular view for Hong Kong banks?
Hong Kong banks, I think both HSBC and Stand Chart our preference because of their the size that they account for more than 50% of the mortgage loans here, and also they and the deposit size, so they enjoy lower funding costs and better net interest margin.
Okay. Next, we do have, I think you mentioned for your recommendation, you mentioned Alibaba, Meituan, and Tencent. So one of the question is, for these three companies as well as for JD.com, who do you think their current main competitors are? Like, who are the people that so-called fighting the market share with them?
Okay. There are more competitors to Alibaba and Jingdong, JD, because they are in the e-commerce arena, and there are more players there. For instance, Pinduoduo, and there are also other up and coming players, such as new competitors, such as the live streaming platforms like Kuaishou, Bilibili. So it's more crowded there. That's why I saw a question asking why, despite the growth in GMV, Alibaba's financial indicator do not look so good. It's because of competition. They need to give a lot of subsidy to lure, to attract customers, so that that erode their profit margin. But for Meituan, I think it's less competitive in the food delivery market in China. Earlier, in terms of market share, was far behind Meituan. So it's less competitive in terms, because it's more labor intensive. You need to have a lot of riders to do the delivery. But for e-commerce, everyone with e-commerce platform can compete, and Meituan now is expanding outside China. In Hong Kong, it's already occupied more than 40%, 44% market share. It's grabbed market share from competitors like Food Panda and Deliveroo. Now is entering Saudi Arabia. So Meituan is seeing less competition compared to the e-commerce players.
Right. Okay. So next one maybe is on, I think, a hot topic for international market, which is coming into China also, which is the semiconductor industry. So there's questions on what is the view on the industry as a whole. And one particular question is asking specifically for SMIC and Hua Hong Semiconductor. And whether you prefer individual stock companies like this for semiconductors, or do you think investors should go into the semiconductor ETF for Hong
Okay.
Kong, China?
Okay, we are having a very cautious view on these two companies, SMIC and Hua Hong, because unless SMIC is able to break through the technology, unless it is able to achieve a technology breakthrough, because US is capping it from developing more advanced chips. Now it's only able to produce, some say is able to produce 7 nanometer chips. Lately, its share price raised so much is because there are market rumors saying that it using DUVs is able to produce 5 nanometer chips. But from the information I gather, even if it's able, because it's not proof yet whether it's really can be able to produce 5 nanometer chips. Even if it's able to, it's believed that the pass rate will be very low, between 20 to 30%. That means the cost will be very pricey. You will sell the production will be only in very limited size. It's still not able to enter mass production in the near term. So based on the current product mix, now they are for SMIC, actually the majority of the income comes from 28 nanometer chips, which actually other players such as Samsung and TSMC already do not have quitted this market. They because they are very low rent, low price product. That's why you notice in the gross profit margin, if you compare NVIDIA or TSMC, the gross margin with SMIC latest quarter, second quarter, the profit margin is only 13%. Okay, down from 20% last year. And then Hua Hong is only 10%. So I think it will be it may take a very long time for they to catch up. I'm also not sure with the US coming in, trying to stop them from getting the necessary equipment to produce more advanced products. It may really take a very long time to close the gap, the technology gap between them and other competitors. So otherwise, they will still be in the low gross profit margin segment going forward. Okay.
All right. So other than the semiconductor, I think another sector that is very popular or for investors as a whole is the China EVs. right? So there's one question asking that the China EVs do face challenges from the Japan Toyota. And he mentioned using different energy sources for the automobile engines. So would the China EV company be impacted as well as the tariff that the European EU side have imposed on the EVs? So what is the overall view on the sector itself?
Okay, the overall view is still optimistic because now they are grabbing market share from uh, two fronts. First, traditional the traditional vehicles, you know, the 汽油的燃油的汽车 okay so in the first half this year actually the China automobile industry was rather flat sales of passenger cars only increased by 4% compared to last year but sales of electric vehicles increased by more than 40% compared to last year. That means now more people, when they buy new cars, they will prefer to buy EV rather than the fuel cars. Okay, so they still see growth because there's more demand for EV in China. So that's the first thing. Okay, and now the penetration rate has risen to around 57%. So there's still room 57% penetration rate for EVs. And with regard to exports, yeah, the tariff issue is negative, is a headwind to these EV makers. But besides Europe and the US, they have other, such as the Middle East, other emerging markets, providing a lot of business opportunity for them, and also ASEAN as well. Okay, ASEAN, I think, importing more and more EVs from China. You may be seeing more and more BYD on the road in Singapore and Malaysia. Okay, and on top of that, it's also stealing market share not only from few cars, but also from foreign car makers and also JVs between foreign car makers and Chinese car makers. So lately there are reports that Toyota and Honda are planning to downsize their production base in China because they lose out to the EV makers in China. So they are still growing. The EVs are still seeing growth because the growth comes from first few cars, okay? The market share from few cars and also the market shares from foreign competitors. And overseas, there are still a lot of untapped markets, which they have a competitive advantage to gain market share there.
Right, so I think another one is two parts to it. It's actually the property side, the real estate market. So I think there's a question whether does the property sector stocks can still be good in the medium to long term investment when you compare it to REITs as a whole, like 0.08283. So which one is actually a better play per se for investors if they are looking for dividend for long term? So either the property construction sector or the REITs itself. And if it's a REITs, what are some of the REITs recommendation that you might have for Hong Kong market?
Okay, for long term, we still reckon that REITs are better than the property developers because now it's estimated that Hong Kong we have unsold homes inventory of more than 100,000 units that will take 2-3 years to digest. So that and property developers are under pressure to slash prices. to reduce their inventory. So we don't expect good financial results in the next one to 2 years, because some are selling at the loss, below the land acquisition price and the construction price, just for the sake of reducing the inventory. And also the like New World, like New World is under tremendous pressure to repay its debt. So it has to sell this, sell that. Not only the residential property, but also I think those who have visited Hong Kong, you may have visited the museum, which is highly, I mean, very reputable for the design, the artistic design. But it was rumored that it looks to sell its museum more in Tsim Sha Tsui because of this financial burden, pressure to repay its debt. So we prefer the REITs. And also property developers, the dividend payout really depends on the earnings performance, and is arbitrary by the management of the company. But REITs are mandated to distribute, I think, 90 or 95% of the earnings every year. So there's more certainty on the dividend side compared to buying property developer stocks. Okay, I'll prefer REITs is still linked REITs which is the biggest link in Hong Kong, and also with a more diversified investment property portfolio.
I think in the presentation you also mentioned about the Alibaba. So I think there's few questions on Alibaba, like what's the resistance level you're looking at, as well as for Ping An and Tencent. So like I think more of like the stock investments opportunity in the support and resistance level.
Okay. You want to show the chart? Alibaba, just now we have suggested the support level is between 103 and 105, which is a good entry point. But now let's look at the chart. The resistance will be 115 and 120. For Alibaba, I think we may not be too mindful about the financial performance in the near future, because I saw the question about his financial performance not doing so well, right? But after the the completion of its dual primary listing, now it has joined the Stock Connect. So it's believed that in the next 6 to 12 months, a lot of southbound money, southbound funds will wish to invest in Alibaba. Okay, so that would be the main catalyst for further share price appreciation. Okay, resistance will be first resistance 115. The other resistance level will be 120, 120. Okay, the other one is 10. Which one? Meituan or Tencent?
Tencent and Ping An. Yeah.
Tencent and Meituan, right?
Ping An.
Tencent.
Yeah.
Ping An, okay. Tencent just now, we suggest 440 to be a good entry point, and the resistance you see latest is 480, the near-term resistance level, and interim target or the next resistance level is 500 Hong Kong dollars. So 440, 480 on the upside, and 500. Entry level is 440. Ping An resistance level you can see yesterday it rose towards $60. Highest was 59.8 and failed to break above the $60 threshold. So $60 is a near-term is a key resistance, whereby near-term resistance is 55. So now it's trading at 51.05. We will suggest to enter to get a lower entry price below 50. There's a maybe around 48, okay, around 48. So it will test the support of the $50, which I'm afraid, may not hold. So if it breaks below $50, the next support level will be 48. And the near-term resistance level is 55, then 60.
Okay, so next we have question. I think just a quick one is actually on the AI players that's in Hong Kong or Hong Kong listed AI players that might be in China. So what are some of the main companies to look at? Maybe is it like Baidu or is it like SenseTime or any other companies?
Yeah, Baidu is one. Alibaba also has some AI, what do you call DNA or AI. But I think one overlooked stock is Legend. Okay, Legend now is embracing more AI into its three business segments, namely the manufacturing of PC and mobile phones, and the other segment is infrastructure, the server. So we expect more demand for AI equipped servers going forward, and also solutions, software as a service will also they will add in more AI elements. Yeah, AI elements. Okay, so Legend close to $10, I think, is a good entry price. Today it dropped to the day low was 10.28 and now trading at 10.60. So between $10 and 10.20 would be a good entry point. Near-term target is 11, and then the key resistance is 12. Okay, and yeah.
Okay. So next one is I think the China market actually not only the stimulus but also was impacted by the US Fed rate cut previously I think in September. So do you think whether the US rate cut upcoming in November and December will it still impact the China Hong Kong market? And whether if US slow down the rate cut, will it be adverse impact? Because we are expecting around 50 basis point cut for
Mm,
US by end of the year. But if US does slow down this rate cut, will it have any impact on the China Hong Kong expectations per se?
Okay, yes, rate cut would certainly help Hong Kong and China, but it would not. It would not. We do not expect a big boost, a big impetus to the Hong Kong and China stock market. More is from the policy side. If China is able to roll out more supportive policies, increase the fiscal support. Then the boost to the stock market will be bigger. Yeah. But if they slow down in the rate cut, I think the rate sensitive stocks may uh, uh, suffer a bit more. The rate sensitive stocks and utility stocks stand to benefit from US rate cuts. So US rate utility stocks here may be less attractive if the US slow down the rate cut pace.
Okay, so maybe because we are also running out of time, all right. Okay, so before I end off, I will just have a last question. I think it's one of the initial questions is, what are some of the quality China or Hong Kong ETF that you think is recommended for new investors into Hong Kong? And then if you, on this aspect itself, there's one question specifically for between 2800 and 2822, which I think is the Hong Kong Tracker Fund versus the A50 fund. Which do you think is a better option currently?
Okay, I will answer the second question first. I think we will prefer 2800 because although sometimes the company, the constituents may be the same, some of the that you may see overlapping of constituents, but the main difference between A share and H share is the premium. Same company trading on two different exchanges at different market price, and one is substantially higher than the other. Okay, so a lot of the A shares are trading at a premium to the H share. H share is at a discount. So for as a consumer, when you buy goods, you probably look for same thing but cheaper price. Am I right? So why is it so? Because the China market is still a closed market. Now there is stock connect, but you can't do arbitrage between the two exchanges, two markets. So the premium or the X share discount still exists and did not narrow as expected. So buying 2822, maybe buying some similar company at a much higher price. So we would suggest investors to buy 2800, the CEI China Enterprise Index, under which most companies are trading at a discount to its A share counterparts. Okay. As for quality ETF, I think there are two high dividend stock ETF, Hong Kong high dividend ETF. You can look up. One is Hang Seng, the other is Ping An high dividend stock ETF. They, for long-term investment, I think they can be considered.
Okay, so I think we have answered quite a fair bit of questions. Let me just look through for any specific one in detail at the end.
Okay, I just add one point. The Ping An Hong Kong high dividend share ETF, the stock code is 3070. And the Hang Seng high dividend ETF, the stock code is 3110.
Okay. Yeah, thanks, Luis, for the great sharing that we do have currently. All right, so actually, I think we already at 1:59, so we will be ending the session. I'd like to thank Luis once again for the very interactive session for the Q&A. All right.